January to end 2026. Please remember this date. Seriously, burn it into your brain, because this might be one of the most darkly ironic, most brutally symbolic days in modern financial history. That cold winter morning, two headlines hit Wall Street at the exact same time. And it didn't feel like normal news. It felt like two high-speed trains colliding on the same track, shattering what millions of investors thought they knew about the world. Headline 1, Warren Buffett officially announces retirement. No grand farewell tour. No emotional speech. No dramatic exit. Just a short announcement. The man who ruled investing for more than half a century, the Oracle of Omaha, hands over the crown. The Berkshire era, as we knew it, ends right there. And the market reacts immediately. Berkshire's Class A shares drop about 1.4% that day. And yeah, in 2025 he still posted a positive return about 10.9%. Even after a decade of profits, that didn't calm anyone down. Because what people felt wasn't just nostalgia. It was fear. And the moment that fear became real, when it stopped being a vibe and turned into a picture, was what happened at the exact same time Buffett walked away. The asset he hated, the asset he mocked, the asset he publicly roasted again and again, gold. On the very first trading day of 2026, spot gold didn't care about the dollar. It didn't care about rates. It ripped higher up about 1 and it briefly smashed through $4,400 an ounce. Think about how insane that is. Every old school investor remembers Buffett's most savage line, "Gold is a goose that doesn't lay eggs." In classic value investing logic, gold is lazy. No cash flow. No dividends. No compounding. It just sits there and shines. The only way you win is if someone else pays more later. That was the old religion. But on January 2, 2026, reality slapped the whole world across the face. That goose that doesn't lay eggs laid the biggest golden egg in modern history right on top of the old god's funeral. And no, this isn't a coincidence. This is a handover ceremony between two eras. Buffett leaving the stage represents the end of the old industrial capitalist age. An age built on America's momentum, corporate moats, globalization, and infinite compounding. Gold being crowned represents the start of a new age. An age built on credit cracking, zero-sum competition, and extreme uncertainty. So if you're still worshipping Buffett like a religion, and you're telling yourself this is just temporary market noise, I'm warning you, you might not even understand how you go broke. Because the real message isn't the retirement headline. The real message is one number buried in Berkshire's financials. The number that should make your skin crawl, 381.6 billion. That's the cash pile Buffett leaves behind, a record, nearly $400 billion in cash. Mainstream media calls it prudence, they call it dry powder, they call it ammo. Stop, don't be naive. But now AI agents can rewrite code overnight. They can migrate data automatically. They can help a new competitor catch up to a giant's 10-year head start in days. So what used to be a moat starts looking like a shallow ditch. Now look at consumer brands. Coca-Cola's moat was brand mindshare. You see the red, can you grab it without thinking? But in the future, your purchase decision might not be made by you. It might be made by your AI assistant. You say, "I want a soda," and AI scans ingredients, your health data, price to value. And it orders a brand you've never heard of, but one that fits your body better. When AI becomes the buyer, emotional branding becomes weaker. And that terrifies Buffett, because it means he can't calculate future cash flows with confidence anymore. He can't know whether that unshakable giant gets disrupted next month by a few people in a garage using a new model. When forever turns into a moment, long-term holding becomes a joke. Now the second thing poisoning value investing is debt. If AI attacks the micro foundation of businesses, debt attacks the macro ground beneath all valuations. Value investing uses a ruler, the discount rate. You bring future cash into today's value. That ruler assumes money itself holds meaning. Buffett always said, never bet against America, because he believed in the US system and the dollar. But look at the number now, 38 trillion in US debt. We are drowning in debt. To keep the system alive, central banks get forced into negative real rates or periodic money printing sprees. And the consequence is brutal. Asset prices stop reflecting fundamentals. They reflect liquidity. Buffett looks at P or E ratios at 30-50, and he knows this is crazy. But in a world where money is cheap and losing value, bubbles become normal. If you don't buy, cash melts. If you do buy, you're buying the top. That's the deadlock. And the terrifying part is, a debt crisis can ignite at any moment. And when it does, value stocks won't be spared, everything gets dumped. In a waterfall, there is no safe blue chip. That $381.6 billion cash pile, it's Buffett's deepest expression of distrust in this casino. He doesn't want to be calculating odds on the night the whole table might get flipped. Now the third thing killing value investing is the simplest and the most humiliating: valuations. We are still paying for the last 15 years of the zero-rate era. Since 2008, central banks pushed everything up with cheap money. And now the world is simple. You can't find a cheap good thing anymore. Value investing is built on one core idea: margin of safety. Pay 40 cents for something worth $1. But today, even trash sells for $1. Blue chips became overcrowded trades. Pensions, ETFs, passive funds, everyone piles into the same core assets, and nobody wants to let go. That means the valuation margin for error is tiny. One earnings miss, one shift in AI, one bad quarter, and a stock can get cut in half. And for Berkshire, it's even worse. With hundreds of billions, Buffett can't operate normally anymore. If he buys, he pushes the price up. If he sells, he crashes it. He becomes a whale trapped in a bathtub. Quality assets are too shallow, his capital is too big. Put all three forces together and you finally understand the sadness behind the $381.6 billion. AI makes forever unknowable. Debt makes the macro ground unstable. Valuations erase margin of safety. So that cash isn't ready to strike, it's homeless. And while Buffett can sit on it, global capital can't sleep forever. If stocks feel unbuyable, if bonds feel unsafe, if dollars feel like a melting ice cube, money has to flow somewhere. The destination has to be big enough, old enough, and strong enough to survive a new world. And all roads point to the one thing Buffett spent his life opposing: gold. And here's where a lot of people still don't get it. This gold move is not some cute little risk-off trade. This is not Andy's buying jewelry. This is a monetary war. Gold ripping toward $4,400 is just the tip of the iceberg. Under the surface, gold is being repriced, redefined from a commodity into a shadow currency. And the real whales behind this are central banks. For decades, central banks were the biggest buyers of U.S. treasuries. They earned dollars, then recycled those dollars into treasuries, helping America keep rates low and prosperity high. But that loop is breaking. China, Russia, India, Turkey, they've been swapping dollar assets for gold at record speed. Why? Because they see the same thing: the dollar-led game is becoming unplayable. When the U.S. can freeze foreign assets whenever it wants. When SWIFT becomes a political weapon. Gold, no counterparty risk, no reliance on any nation's promise, becomes the final safety cushion. Every ton of gold shipped east is a silent vote of no confidence in dollar hegemony. And when central banks de-dollarize through gold purchases, the pricing logic changes. Gold stops caring so much about U.S. real rates. It starts pricing global credit fractures. The deeper the crack, the higher the price. That's why even if the Fed tightens, even if the dollar bounces, gold can still climb. Because people aren't buying yield. They're buying the right not to die with the dollar. Now, on top of the macro war, gold also hedges the three forces we just talked about. AI makes digital stuff cheap. Code, content, even truth can be manufactured. So what becomes scarce? Reality, physical existence. Gold is element 79. AI can't generate a gram of it by writing code. You need mining, refining, energy, time, real-world friction. When AI floods the world with synthetic value, gold becomes a physical anchor: condensed energy, something the digital world can't fake. Then there's debt. Fiat money is basically an IOU. Dollars are an IOU. Euros are an IOU. As long as printers run, IOUs multiply. Value dilutes. Gold is a zero-debt asset. It doesn't owe anyone anything. When promises start looking fragile, gold is the thing that doesn't default. Buffett said gold doesn't lay eggs. Sure. But in a world where eggs can rot, the goose itself might be the only thing still alive. And this is where people mess up. They see $4,400 and they say, too high, bubble. That's linear thinking. If you look through old eyes, yes, it looks expensive. But if you look through money supply and credit expansion, it can look cheap. 1980 gold hit 850, but what was the money supply then? What was global credit then? Now look at 2006. Look at how much has been printed. Look at how much debt exists. If you measure gold against total fiat dilution, you might realize the real price is not as extreme as it looks. And the most important shift is this: gold is being remonetized. It used to trade like copper or soybeans, now it trades like a parallel currency. When you benchmark gold against fiat currencies that can be diluted, the ceiling changes. If dollar credibility drops 10, gold can rise 10% without any story. If the world slides into higher inflation, you don't argue about whether gold is expensive, you ask how many zeros might get added. So yes, I'll say it, 400 might not be the top. It might be the starting line. Now, if you're listening carefully, you might be thinking, okay, then I'll just go buy physical gold tomorrow. Stop, seriously stop. If you do that, you're using old thinking in a new era. Buying gold bars from a shop is one of the lowest efficiency, highest friction ways to participate. Let's do the simplest math. When you buy physical gold, you don't pay spot price. You pay spot plus brand premium, processing fees, and taxes. The moment you buy, you're often already 10% to 15% above the international price. And when you need cash and you sell, they don't buy it back at the price they sold it to you for, they buy it back at a discount, sometimes 5% to 10% below base price plus extra loss fees. Round trip, you can lose 20% just on spread. That means gold has to jump 20% before you even break even. So remember this: physical gold is for apocalypse insurance, not for efficient wealth growth. It's what you keep for the 1 in 10,000 scenario when the grid goes down and banking apps don't open. It's insurance, and insurance is something you consume, not something you build your entire portfolio on. So what do smart players use? They use the higher level version of gold exposure, gold mining stocks. Because miners have operating leverage. You don't need fancy finance to understand this, just basic math. If gold is $2,000 an ounce and a miner's cost is $1,500, profit per ounce is $500. Now gold rises 20% to $2,400. Costs don't rise nearly as fast, profit becomes $900. Gold went up 20, profit went up 80, that's leverage. That's why in gold bull markets, quality miners and miner ETFs can outperform the metal itself. Buy gold and you get addition, buy miners and you can get multiplication. Now, miners have risks, obviously. So if you hate single stock risk, you want liquidity, and you don't want the physical gold spread problem, then gold ETFs exist for a reason. They're liquid, low friction, and easy to trade. And in a violent environment, liquidity itself becomes value. And then there's digital gold, gold ownership wrapped in modern settlement rails. For people who want portability and speed, it can be efficient, depending on local rules. The bigger point is this: stop viewing gold with an old era mindset. Don't be the person who thinks the only way to own gold is to hide bars under a mattress. In this era where value investing is getting killed and gold is being crowned, you need tools. If you want survival, keep a small amount of physical. If you want preservation, use ETFs. If you want offensive upside, study quality miners. Pick the right tool and you can earn multiples of the gold move. Pick the wrong tool and you'll watch gold climb while your returns get eaten by friction and inflation. Now, we started with January to end, 2006. An old god stepped down, a new king surged. So don't just see Buffett's retirement as a goodbye, see it as a warning. The American dream era, the era where you could buy and hold and automatically win, has ended. We are not just switching an investment cycle, we're switching the underlying logic of the civilization game. For 40 years, we lived in a world that was baking a bigger cake. Globalization, peace dividends, the internet, wealth expanded. In that world, you could be a friend of time. Buffett made sense. But now we are entering a world that is fighting over the cake. AI fights for jobs, debt fights for purchasing power, geopolitics fights for resources. This is a brutal zero-sum, maybe even negative-sum era. In this new world, growth is scarce, survival is the theme. So if you're still holding the old map, still believing some random blue chips will carry you safely to retirement, you might not just underperform, you might get wiped. Even Buffett sees it, that's why he left with cash. That's why gold got crowned on the same day. So here's the one thing I want you to do after this video. Open your portfolio, look at what you own, and ask yourself 3 questions brutally. Can it survive without the dollar? Can it survive if AI changes the rules overnight? Does it have physical reality, something that still matters if the digital world gets distorted? If the answer is no, then what you're holding isn't an asset, it's risk. It's a stack of promises. And in a world where debt is about to explode, credit promises are the cheapest thing on earth. So move while the music hasn't stopped. Swap fantasy narratives for real assets. Swap paper promises for things that can't be printed. And stop negotiating the price of a lifeboat ticket in a flood. Gold is that ticket, not because it makes you rich, because it helps you survive when the old world collapses. Don't be the last person to realize the truth. Don't be the person clutching paper and sinking. The train has switched tracks, you can hear it. See you in the new world.